Hello and welcome to the market update here for Tuesday, May the 2nd. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com and I'll be happy to answer those for you. Let's get started. We did see in the longer term, I mentioned this in the last update, that if the market continued to push higher, that we'd see the signal, the long-term signal, flip over from a bear market into a bull market. We have seen that. We'll see if it lasts. Like I mentioned with the pattern, if you go down here, you can see the longer-term pattern. It flashed that bull market arrow right there. But again, what we're concerned about is whether or not this is just wave A right here, this kind of corrective-looking rally is just wave B, and then we're going to get a wave C coming down to these lower levels. Now, in the near term, it's looked, well, until today, it looked more like we could break out above, break out a little bit further in the near term, move up a little bit further in the near term. But we'll have to see how today's reversal closes. If we close near the lows of the day, if the VIX gets back up towards 20, which was close to that earlier today, we'll see if there's, maybe the beginning of a sell-off. But we thought that before, and people have been buying the bearish. It's not even buying the dips; it's buying the bearish reversal candle. But again, if you look from the long side, if you've been long the market, you haven't done very well. You have these days like today where it looks like we're breaking out yesterday, and then it reverses today, and it's a tough market to trade. It is what it is. Hopefully it'll resolve itself soon. I pointed this out in an earlier update, just going back and looking at history, and typically you get, typically the market is in these longer moves, whether it's up or down. Here was the COVID downturn right here. That was the quickest downward move we've ever seen. But we don't see this choppiness like we've seen, particularly since the beginning of the year. Actually, last year wasn't too bad. We were trending down, but we were trending down pretty sharply. We'd had the counter trend rallies, but since the beginning of the year, this real sideways type movement has been really tough to kind of deal with. But it happens. The one thing I've learned in the market is that it's going to do sometimes what you don't expect it to do, and it's going to remain in periods longer than you think it should remain in those periods, and you just have to deal with it. It's part of what makes a market. If you can know what's going to happen, then you don't have a marketplace. In fact, I was having this discussion with a friend of mine. Excuse me. We were talking about the evolution of AI. I've been trying to follow this a little bit because I know that it's going to be one of those things like the internet changed the world. It's going to be one of those things that changes the world. It's going to change jobs. In fact, I think it's something you need to, if you're younger and you're in a particular business, you've been in it for years, you might want to try to follow and see how AI could affect your line of work, because it might mean that you might have to change occupations within the next 10 years. It could phase out your job. It phase out my job as a stock market instructor. You can teach a computer to probably do what I do. But we were having a discussion about how AI might affect the stock market. And could you have a machine that, it gets to the point where it's never wrong? All you do is make money. Well, you don't have a marketplace in that situation. There's got to be uncertainty that no one can know exactly what's going to happen next. Excuse me. These allergies are really killing me. Sorry. But you can't have a marketplace unless you have some uncertainty. So I could see AI taking over stock market stuff, but what it would come down to is whose AI was better than others, because you'd have to have some weakness to exploit. I don't know. I don't know how it's going to affect, or there'd have to be rules in place that would prevent AI from being in the market somehow. I don't know how you do that, but it's interesting to kind of follow that stuff and to wonder about how it will affect the future. But anyway, getting back, so we're still kind of in this sideways range. We're trying to determine whether we're going to break out or pull back. I think the Fed meeting this week could be real critical, probably more critical than it's been over the last few Fed meetings. But it gets back to, everyone's assuming the Fed's going to raise a quarter point. A lot of people are saying that's going to be very detrimental to the banks if that happens, and we already have this bank crisis coming back. There's another thing to talk about. I told you that it didn't go away. JP Morgan came out yesterday when they took over what is that bank? Always slips my mind. But they took over that other bank, and they said that the problem is over. This particular problem is over. What we're seeing today is just like we see in sports. Whenever the owner comes out and gives the vote of confidence to the coach's job is safe. He's not going to be fired. That's always a signal that he's going to be fired within days. It never seems to work. And, so that JP Morgan statement yesterday, again, I was thinking the same thing. And I've talked about this in the class before, that using that sports analogy, that that vote of confidence is not what you do, because it's almost a kiss of death when you come out and say that. And sure enough, we're seeing that today with a lot of the regional banks just getting hammered today. And so we'll see what the Fed does. But this gets back to what I've been talking about all along, which is the Fed is going to their choices are defeat inflation or prevent a recession. There's not a soft landing. There's not a way through this where there's no pain. And I held out hope that there's a possibility that there could be, because that means that there's no pain for anybody. But realistically, it's just not going to happen. And so we know that the Fed is they're willing to crash the economy to stomp out inflation. And if they don't, then inflation will come right back. And so I think we're seeing that. I think the market, which hasn't recognized that possibility yet, is starting to see that. And we'll see if it starts to trade it. We'll see here in the next little bit if it leads to another move lower. One thing to point out on the other indicators, momentum has moved back up with the recent rally. But again, we're seeing the breadth lagging, and not as much as it was before, but it's still lagging. It means that there's fewer stocks that are causing the rally. A lot of the focus has been on the big cap tech the last week with Google and Microsoft and Amazon reporting, and Meta, and a lot of those, we saw moves higher on those reports, at least initially. But there's been a lot of stocks that the earnings haven't hit and they've declined. And so again, there's just a disconnect there within the market breadth, where there's fewer stocks that are kind of leading the rally. We'd like to see that breadth catch up with momentum at the very least. Sentiment's still high. And again, this other sentiment indicator gets back to what I've been talking about, which even if we do break out and rally, how much further are we going to go before we bump into this overbought condition? And again, there's a lot of headwinds to a rally, but we're not seeing the sell-off. We're just kind of stuck in this range right now. Buy-sell ratios started to widen a little bit, but they're back closer together. And again, look at that. This is unusual tightness right in through here. Where have you seen that? You can go back a number of years and you're not going to see that long of a period of moving sideways like that. All right, let's get to the charts. So again, the S&P has been kind of bumping up against this resistance area. I'll go back to a 1-year chart. You can kind of see a little bit better. Looked like we could be breaking out yesterday, but we had it started to, and then it came right back down. We had this kind of bearish reversal candle. And again, it's important to be able to read that, to read the momentum change right there. You can see it rallied up strong early, and the sellers were able to push it all the way back down to where it opened. So it's not surprising that we're down today. Although I thought with the Fed meeting on Wednesday that maybe we could see another attempt to rally, or at least be real flat today ahead of that. So, to see it to kind of have a pretty decent move today ahead of that Fed meeting is interesting. Now we are at the lows of the day, so it'll be interesting to see how we close. The buyers have pushed the price back up a little bit. Do they push it up further? But if they are able to push it up further, it really tells a story of what we're in right now. We're in this battle. Sellers can't push it down, buyers can't push it up very far, and we're kind of stuck in that range. Now, if we do close near the lows of the day, that'd be very bearish ahead of that Fed meeting tomorrow. Could mean that we're starting to move lower, although I thought that on this day right here, we've broken the key support level, closed below it. We did move lower the next day, but then this day was really puzzling. That was last Thursday when we had that big rally right after dropping on Wednesday, or looking like we were breaking support on Wednesday. So again, really difficult. But it gets back to what we say all the time, which is you can't know exactly what the market's going to do. And sometimes the market will lull you in a sense of false confidence, thinking that even with reading candles and chart patterns and price action, and you think you know what's going to happen next just because the probabilities are there. It normally will do that. And then every now and then the market will make the lower probability move. It has to remind everybody that you don't know what's going to happen next. And we're seeing a lot of that over the last couple of weeks or so, where and again, you take the, if I have an overall bearish outlook, which I have had, as many of you know, for the most part, then obviously you're thinking the market's going to drop on that break of support. You have these big, strong days, and if you're bullish on the market, you're saying, yeah, Jerry, you're an idiot. The market is going to go higher. And guess what? You're wrong today with this reversal here too. So again, this backs up my argument that I mentioned last week, which is, doesn't matter whether you're bullish or bearish, the market is not following through in any direction in any strong way right now to confirm whatever bias you might have or whatever outlook you might have. So it's really fooling a lot of people, and it typically means that a lot of people aren't making money when that happens as well. And I would make the argument the only people that are making money are the ones that are doing strategies that are centered around the market moving sideways or not going anywhere. And there are option strategies you can use that where you can profit from that, but typically they're they're a little complex and they don't usually make very much money. And so you tend to work twice as hard for half as much money is usually the argument I make there. But we'll see. Now, I would argue that you'd want to, if this move down is significant, you'd want to break that support level again. If you fail to break that support level, then obviously that would embolden the buyers to step back in. And then obviously we're still waiting for this break of resistance here. Can we break out above this point? And I think because we've had these reversals a lot lately in these key areas, that it'd be wise to wait until you actually break above or below those areas again. Although we did break clearly below it that last Wednesday and it didn't hold. But you got to the thing you got to be careful of in these type of market conditions is you got to be careful not to abandon your technique. If you've got a technique that's been working and it's been working over a long period of time, you got to be careful not to abandon that or start making massive changes to it just because the market has been doing some weird things lately. I would make the argument that you either want to sit out and not do anything at all, or just keep trading your system, even if you're getting stopped out of trades and it doesn't seem like you're making anything. Stick to what works over a long period of time. Now, if these conditions last another 6 months, maybe you do have a different type of marketplace, and maybe it is going to be different going forward, and maybe you do have to find a new system. But I learned so many lessons about trading from playing baseball, and I've shared many of those with you over a period of time. But one of the things that I've learned that stuck with me is, in baseball, you're going to have ups and downs. You learn how to deal with those ups and downs. You're going to have a hitting streak that it feels like you can't, you see that baseball really well and you can't miss it. And then there are hitting slumps that where you seem like you can't see it at all. And there's an ebb and flow to that process. And one of the things you're taught to do when you're having a hitting slump is to not make major changes to your swing right away. It's part of the game that you're going to have that ebb and flow. And one mistake that people make is they'll have a little bit of a hitting slump and they'll start changing drastic changes to the way they swing the bat. And it just compounds the problem, makes it even worse. And sometimes it destroys their baseball career when they start to do that. So now, on the other hand, if your slump is lasting a whole season, that means that it's kind of beyond that ebb and flow, so to speak. Then you gotta just start playing with your swing a little bit and finding out what could be wrong and where the holes are in your swing, or so to speak. But you don't want to overreact, and probably the better thing in this marketplace is to sit out. If you're afraid of, if you've lost money already and you're afraid of losing more, sit on the sidelines for a little bit. I'm not saying sit on the sidelines forever, but kind of wait until the market can break out above this area, break out below this area, show you something than what it's done for the last month, which is completely moved sideways right in this area right here. And overall, it's been moving sideways since the beginning of the year. You back out and you look at that 1 year chart, you could pretty much outline that, boy, until we significantly break out above here or below here, for pretty much the whole year we've just been stuck in this range. And, I can make money when the market moves. There are strategies we can do if the market's going to go lower. We've done that in the portfolio. We've bought those inverse ETFs where we don't have to be short the market. but we really need to break out of this range that we're in. And if I were to highlight it, this is where I'd put it. Resistance up here. Let me use the break out above here, break down below here. And now again, can we trade in this area right here? We have moved up and down through this area right here. Yeah, we can trade that. But again, the risk is that you could still be getting stopped out of things, and you could be just trading and treading water where you're not going anywhere. And that's kind of where we've been in the portfolio. We've been kind of stuck in this 139,000 area. Been stuck in that for months, where we've gone up a little bit, down a little bit, and that's fine. I'm okay with that in a bear market condition. But it is kind of frustrating where you're putting in a lot of work and it's not showing anything. I get that. Okay. All right. So S&P, we're watching that resistance area. The Dow, same thing. It bumped into this resistance here. Pretty significant move down today. Qs did kind of break out a little bit on Friday. We did close higher, broke out of that area, but we're right back down below it again. Now, again, this could just be a little bit of a pause, and it could still move higher. I don't want to overreact. I really want to see how things close today. Like I said, if it closes near the lows of the day, that would be pretty significant, especially if the volume is there. But like I said, I thought last Wednesday was significant. We had that key support level, clearly broke below it. Or is that might have been Tuesday, Wednesday? Yeah, because Wednesday the Nasdaq rallied a little bit. I think that was off of the Meta earnings. I think at that point. Yeah, so that was Tuesday's move down right there. But it significantly broke that support level, and I thought things were heading lower at that point, in it reversed. So Russell 2000 is down the biggest percentage today, as it should, because it has a lot of the regional banks in there. But again, this is something I've been pointing out for a number of weeks now, which is that the Russell 2000 tends to be a leadership index, tends to kind of lead the way. It really lagged the rally that took place in March, didn't rally very much. Again, it's already back down to those March lows, or pretty close to them right here. Is this telling us that the markets will roll over soon? Again, you don't want to base a decision on that, an immediate decision on that, or base your trades off of that divergence, because it can last for months. We saw this happen a couple of years ago, where the Nasdaq or the Russell 2000 moved sideways for a number of months, where the S&P was going and the Nasdaq were going higher. Ultimately, they did roll over and everything dropped. And you can look back and say the Russell 2000 was signaling that, but it took months before that actually happened. So, but that would help to, if we did break lower on the Russell, and it does break that support first, you gotta assume that the other indexes should be following at some point, and so you start to see any sort of major bearish reversal that takes place, that it could lead to a further decline at that point. So again, you want to be careful not to make it the primary reason for your trade, but it definitely would be something that would make you lean towards being more bearish in the longer term. Hold on just a second here. Question: if we did not have your software and market analysis, how would we determine if we're in a long-term bull or bear market? That's a good question, because one of the problems is that there's there's a lot of different interpretations of what is a bull market and a bear market. And so it would depend on what your definition is of a bull market or bear market. Some people would say it's a certain percentage that you dropped from the highs. Some people, and there's just a lot of different interpretations. Now, the software, and that gets back to our software. Our software is based on an algorithm where it says that based on this calculation, we think that we moved into a bull market based on that calculation. And again, this gets back to what I've talked about several times. I'm not necessarily suggesting to ignore that signal, but there's people that use the software just purely for a signal type system. They want to, they don't want to learn how to trade. They just want the software to tell them when to get in, when to get out, and so the algorithms can tell them when it's best to get in, when best to get out, and they can just follow those, the whole way the software is set up. There are advantages you can have if you're willing to learn additional things, chart patterns. Hold on just a second. Chart patterns and price action, things like that. It can allow you to recognize additional things that you can use to make your decisions. Okay, so and it can allow you to trade better. I truly believe that someone that knows how to trade is always going to be able to outperform. Well, I shouldn't say that, because it depends on their system too, their money management system, their trade management system. But typically, I would assume that they would be able to outperform someone that's just following a signal system, just because you should be able to. You should be able to, with additional knowledge, additional work, you should be able to outperform. It's like a sports analogy. Someone that works on football 7 days a week and 4 hours a day should be able to outperform me that does hardly any exercise and jumps out on the football. They should be able to outperform me. It would be an insult if they couldn't outperform me. And I think the same way about what you put into your chart analysis and stock market work. You should be able to outperform a pure signal system. That's not discounting or discrediting a signal system, because the algorithms do work over time and they do allow you to simplify the process. But so again, I'm kind of going on and on about, but to answer your question, it would depend on your interpretation of a bull market or bear market. A lot of it too could just be on your ability to read the chart. You're trending downward over a long period of time, you're probably in more of a bear market condition. If you're trending upward over a longer period of time, a good chance that you're in a bull market condition. So just being able to read the chart is, you don't need me to tell you whether we're in a bull market or bear market. If you're able to just read the chart, you should be able to get that trend direction right. Whether even early too or late, because a lot of times those, usually you don't recognize you're in a bull market until you've been in an uptrend for a period of time. And again, this is the advantage of reading the trend, is you could get into that bull market early before it switches into a bull market for most people, because you're able to see those subtle changes in trend. And I've taught you these over the years where, that stair step, impulsive up, corrective, impulsive up. Typically in trend reversals, you get back-to-back impulsive moves in the opposite direction. And then a downtrend, your rallies are more of the choppy, corrective type moves. You get that down. This is I know it's a general guideline there, but if you get that down, you're more likely to be on the right side of reading those trends than on the wrong side. And that's what's caused us to be questioning where we're at right now. We've got this impulsive move down. This looks corrective. what should follow is another impulsive move down. Once this corrective move is done, we should see another impulsive move down, whether that happens right now or whether it's going to happen, whether we're not done with this corrective move yet. That's what we're still kind of waiting on. But that's the reason for remaining more bearish, even though some of the signals are turning more bullish. Is that chart behavior is telling us that it's at least making us question whether we can rally here or rally significantly here, and so we don't want to ignore that completely. All right, TLT, significant move yesterday. We broke below this support level. I told you we were watching this. That would be bearish for bonds if we broke below that. We did, and then we had this move up today. We're right back, and again, this is very similar to what the market's been doing, and so it's not uncommon to see it in other areas besides just the indexes that we're seeing this indecision. We're seeing it in the bond market. This will likely react to the Fed meeting tomorrow, whatever they do, whether we break back below here or rally back up towards this resistance area here. So we'll see. We'll see if that was a false breakout or breakdown in this case. We'll see if that ends up being the case. But I thought that was significant yesterday that we did break below that. What that means is that the bond yields are rising. And that's a sign that, again, the bond market is expecting a recession. If we start to see this break significantly lower, it would be the bond market signaling a pretty severe recession or pretty bad recession. And again, a lot of this could tie into what the Fed says tomorrow. Not so much what they do, but what they say. Are they going to continue to raise rates? By the way, if they do say they're going to pause or hint that they're going to pause, keep in mind that doesn't mean that they're done. It means that they're just pausing. If inflation isn't coming down on its own in the next Fed meeting, which will be 6 weeks from tomorrow, then guess what? They're going to have probably another quarter point rate hike again. And so, and again, if you believe that the Fed is they're wanting to cause recession, slow down the economy, cause unemployment. And again, I don't see how you can have a recession without unemployment. And that's the scary thing, is that means that I could be out of a job, that you could be out of a job. But at least I know what the Fed is doing, what they're, you say don't fight the Fed. Well, a lot of people are fighting the market's been fighting the Fed. It's pretty clear what they're trying to do and what side they're on. And it's just a matter of when the market, reads that. I thought it was kind of reading that yesterday with the decline below the support level, but managed to rebound today. So we'll watch that. We'll probably know a little bit more on Thursday when we have the Thursday update, how that's playing out. Gold is moving sideways, but in a significant area. This is a breakout area, so that's still a good sign that it's holding this support area, consolidating a little bit. I would assume that it's going to continue to move up. But remember, this is a major resistance area. You go back decades. There's a trend line that comes through right in this area right here where we're right at it. And so if you're wondering why it's been struggling to get above it or stay above it, there's a reason there. Everyone can, if you look at a long-term chart of gold, it stands out. There's definitely, you would expect some consolidation in this area, but overall, the trend still looks like we should break out higher. Now, maybe we have a dip near term where it pulls back a little bit further and then goes higher, but ultimately it's showing that it should go higher in the longer term. If you're willing to stomach a little bit of volatility and you've been wondering about gold or silver, I think this is the time. If you want to buy and hold for the long term, this is a time to do it. Knowing that's not going to go straight up, but a very, very significant resistance area and very significant longer term trend that's indicating much higher moves over the next decade in gold and silver. So, and still really bullish on gold. Oil, again, I turned a little bit more bullish last week on this little rally, but we have big move down. Again, this could be related to expectation of recession. We are at a significant support area. We have gone lower than that, but that's a pretty big move. Not looking great for oil, but it's been stuck in the sideways range, and so I can't say that I expect oil to fall apart. Again, when we back out, look at a 2-year chart. We have been in this range for a long time. So this going all the way back to last year, we've been in the sideways range, and it looked like we were breaking below it here. But remember too, there's a lot of there could be some demand that picks up with the government replenishing the strategic petroleum reserve. Keep in mind that can't happen until there's a debt ceiling. The debt ceiling gets raised, which it'll likely get raised. By the way, if you're wondering how that'll play out, it does. It's the same thing every time. And who knows? Maybe this time it's different, but I seriously doubt it because of the damage it would do. They'll be fighting back and forth. There'll be a stalemate until right before the deadline, and then something will get solved. And so if there's a market reaction based off of the debt ceiling debate, it's not like it'll last very long. I think they said the deadline was July, or is it June or July? June, or it might have been June, a month or so. All that means is that there'll be a lot of chaos, and then it'll get solved, and there'll be. It's just the way it always happens. And so I don't get too. I try not to get too emotional about that particular debate, because it seems to be the same process every time. Although we're in a age this year where it seems like all the lower probability events are taking place, so maybe this is a year where it doesn't get solved and we default on our debt and chaos starts taking place. But anyway, we'll watch that. But it's not insignificant that we don't want to ignore the fact that it's a pretty big down day, and if it breaks that final kind of support area right there, we could be testing these lows back in March. Definitely the move has been down over the last month. I guess what's kind of odd is that a lot of the oil stocks were looking a lot more bullish, and oil stocks don't always follow exactly the chart of oil itself, but a lot of them had some bullish patterns. I had a couple of recent bullish trades in oil that are now rolling over a little bit, but we'll see what happens there. The dollar started to move up a little bit. We're still in the sideways range. Again, a lot of indecision as far as the dollar is concerned. It started to move up yesterday, and now it's back down today. We talked about, could this be a kind of a bearish ABC pattern that leads to another move down, or is this kind of a bowl-shaped move that's leading to a move up? Again, until we kind of break out of that sideways range, there is a little bit of resistance right here. See if we can break out above that. You have the support down here. See if we break below that. Again, kind of going back to the rest of the market. Break above a certain area, it's bullish. Break down below a certain area, it's bearish. There with the dollar as well. And that can have an impact on oil and gold and silver as well. They tend to move inversely. And then the VIX, let's flip over to now we did touch or get up close to 20 today. Now we backed off of that. But again, market rallied and immediately the VIX rolled over. And last week I was saying that I didn't mind the market rally, but I didn't want to see the VIX come crashing all the way back down again, because then you're right back in that same situation where how much can you rally with the VIX down below 16? And we did get below 16 on Friday there. We closed below 16. and you're seeing the reason why I use this. It's the market's getting ready to break out, but the VIX is down below 16. Even if it does break out, how far can it go with the VIX down that low? And we're seeing the result of that it reversed. It didn't break out. It didn't hold the breakout. It reversed, and now it's selling off a little bit. Now, the pattern though has been it gets back up here to 20, and then the market starts rallying back up again, and the VIX comes back down again, and so we'll see if there's any follow through to today's move. That was a pretty big move though, coming from all the way down here up to about 20. Normally there should be some follow through that. Normally this would be a signal that a bigger drop is coming, but we've had a lot of these false moves lately, and it's shaken my confidence as well in some of these things, at least in the near term. But that's a pretty big move today, and so. But like I said, let's see how we close. S&P's off the lows of the day. If we close at the lows of the day, it probably means that we have another move lower tomorrow, at least ahead of the Fed meeting, and then who knows what happens after the Fed meeting. But and also keep in mind that something I've said a lot. There are a lot of false moves once the Fed decision comes out. We've seen that a number of times, and it doesn't always. It not only can reverse and go back and forth that same day. Sometimes it'll make an initial reaction with the news that comes out, and then when the news conference takes place and they're asking Chairman Powell questions, it can reverse again, or sometimes it'll reverse. But it also happens a few days after as well, where we can see initial reaction and an opposite reaction later. So. Keep that in mind, especially if there's a rally off of that meeting. Again, just because of all the other things I've been looking at and talking about, I wouldn't trust a rally, especially if the VIX came right back down to 15 again. That could be maybe signal that maybe that move is a false move. But anyway, just keep that in mind. Hopefully by now you've learned not to jump into some of those, or really you shouldn't be trading on those Fed meeting days, or at least not doing a lot of big trades on those Fed meeting days because of some of those false moves that could take place. Chip stocks again signaling weakness. The NASDAQ 100 was breaking out, but again the chip stocks have been declining. Again, let's compare that. We want to compare this to is the QQQ, NASDAQ 100. And again, the chip stocks tend to be the leading indicator. So we have the Qs breaking out or trying to break out, but we have the chip stocks that aren't close to breaking out. So again, this is not an exact thing to look at, but be aware that can be that it's not confirming the NASDAQ 100 breaking out. It's actually warning that could be a false breakout the way the chip stocks are behaving. And then the Dow Industrials versus the Dow Transports, pretty good strong rally on the transports right through here. But overall, the pattern has been, we talked about this kind of head and shoulders pattern. And what happens a lot is you break the neckline, then you retest it. I don't know if that's a retest or this should bounce a little bit above it again. We're really right back at it, so we'll see, does it roll over again right here? And if not, if it starts to break out and go higher, that would be a positive transport. If the transports are outperforming the industrials, that'd be a bullish divergence that's taking place. So you don't want to ignore that as well. We don't only look at bearish divergences. Bitcoin. Now, last week when we had this drop right here, I was suggesting that maybe that was just wave A, you get wave B and wave C. Then it started to rally pretty strongly, but now it's well, I don't know. It's rebounded a little bit today. It could be that this is A, B, C for B, and then you get wave C. it's probably due for a little bit of a larger correction after that big run up it had. Doesn't mean it has to have. That could be the correction, but again, look at the way it's been behaving right here. It's more sideways, more sluggish as it's trying to rally. That tends to be what a B wave looks like, or acts like. So again, that's why we learn these things, is they can help us in recognizing, when a chart is acting like a impulsive move or acting like a corrective move. Right now it's acting like a corrective move, and could it be that corrective move within the corrective move, meaning that B wave within the larger ABC correction? That's what we're kind of looking at right now, or it's kind of acting that way right now. So that's what I would assume is taking place. All right. So again, overall analysis, we're still in kind of the sideways range. Unless we can break significantly above this resistance area, we don't want to be buying too much, but we're not dropping sharply either. So overall, my analysis would tell me to not do anything, or be very selective in what you're doing, and until we can see something a little bit more significant. I will leave you with a couple of potential patterns, though, just so if you're looking for that each class. But I definitely am not suggesting all of these. And some of these would probably need a little bit of confirmation. This first, let's see, no, that's not what I wanted. Actually, this one, let me stick on this one here for a second, because it is forming a little bit of a bowl-shaped move right here, and it's moving a little bit sideways through here. You could wait for the breakout and buy the breakout. If it is a cup with handle formation and it breaks out, you can use the distance of the top of the bowl, the bottom of the bowl, project that forward. It gives you kind of a target area. I like this MLTX 99 strength rank. Again, just the overall larger pattern. This looks like a consolidation. If it can break it, today's move isn't real great. If it can kind of break out above this area right here, it could be, and again, if you get the market to break out, that'd be one that could go along with the market, kind of reflecting what the market's done over the last, since the beginning of the year, moving sideways with it. If the market takes off, it could take off a little bit with it. Although it's in a sector that's been doing pretty well. We talked a little bit about the biotechs and medical sector. So a lot of those stocks have been outperforming the market lately. Another one was this PTGX. Again, another biotech stock. What I liked about this one was it looked like a larger ABC pattern right here. And then you have an impulsive up and then corrective. Kind of similar to one of the ones we're in right now. We'll look at the portfolio here in just a second. But kind of the same idea, where it looks like it's gone through its correction, had a start of a move and then a smaller correction. There again, you could just, because that correction took place right here, you could wait for it to break out above that as additional confirmation. Wouldn't be a bad idea in these conditions to do that. Another one, VTYX, another biotech. Again, it's not. I don't think it's a coincidence that we're seeing a lot of these biotech stock, or a lot of stocks showing up from the biotech sector. It's been moving, like I said, quite a bit recently, and so that's the benefit of the software. It's telling you what sectors are moving, and it's really kind of ahead of what everyone's talking about. A lot of people are talking about biotechs. Eventually, they will, if they continue to move higher. But now this could be wave A, wave B, and today's a bearish candle, so it could be in a wave C. before going higher. Here again, you could probably use this resistance area right here. If we can break out above that, it should go work its way back up to that previous high. I like the fact that it had this big down move and it's got impulsive up and it's more corrective looking. Usually a sign that you're in a trend reverse, early signs of the trend reversal into an uptrend. Now again, biotech stocks can be very volatile though too. You don't want to have a ton of your money in biotechs because you can make a lot of money very quickly and then you can lose it very quickly too. They can be very tough to follow sometimes. And then one more, this ROIV, again, another biotech stock. Kind of the same thing, have this correction right through here. You draw a trend line down through there. It broke above, it kind of impulsive up, and then this is more corrective back down. Again, kind of a bearish candles day. You want to start to move back up, maybe even break above this resistance. There's a lot of resistance right here. Wouldn't be a bad thing to wait for it to break above that. But it's looking like it could be going up the right side of the bowl. One of my favorite patterns to trade, especially when it breaks that downtrend line. And we need a real clear higher low, so that'd be another reason to wait for confirmation. If it can move higher and give you a real clear higher low right there, and if it can break above here and give you the higher high, I don't have the higher high yet. Both those things could really increase the probability of that particular pattern working out. So something to keep an eye on there. All right, that's all I have. Like I said, we'll see how things. I was going to go over the portfolio here real quick. Let me do that. I did get out of the SOXS. I was only using that as a hedge when the market was showing it was rallying. Now we could rethink that, getting back into that with today's move. Maybe if we close near the lows of the day, I might jump back in it again. Gold, like I said, no reason to get out of this. It still looks pretty bearish. Had a big bearish reversal candle yesterday on silver, but it seems to be holding this breakout area right here. Our stop's down below here, I think. So we got plenty of room on this one. And nice bullish candle today to reverse yesterday's move. So, and then again, this is very similar to some of those other patterns. Big decline, you had impulsive up, and then we were moving sideways through here. We had the breakout yesterday. We've kind of moved up a little bit higher today on a down day in the market. That's a pretty good sign. Our stop is down below here. Now we have broken out. We could move the stop up. I think I'm going to do that just because of if this is going to become a bigger sell-off in the market, then I don't want to lose money I don't need to lose. That's clearly broken out of that range. Excuse me. And today's move kind of confirms that it wasn't just a one-day breakout. Let's move it up. 898 seems to be near that low. Let's move it up to 895, our stop. So we're going to go from 710 to 895. Let me here. Hold on here. Let's try that again. 895. And we got it at $10.24. So, that would reduce that risk down quite a bit. Feel a little bit better about that. And then, like I said, we'll keep an eye on take a look at the SPY and see how it still kind of in the same area. See how it closes. See if the VIX moves elevated again, moves up a little bit there too. We'll watch for that. All right, that's all I have. Have a great week. We'll see you on Thursday for the stock specific class. Have a great week, everyone. Bye now.